Today we're going to dive into one of the most underrated, yet absolutely crucial topics in investing: dilution of ownership in a business. It's not just some accounting jargon, it's a real mechanism that can either help a company grow or quietly shrink your slice of the pie. In this video, we'll break down why even honest decisions made by management can cost investors their future profits, what kinds of dilution exist, how to tell harmful dilution from smart strategic moves, and why you should always keep an eye on how many shares are floating around. Stick around to the end to find out how not to lose money just because you believe the company's good news. Don't forget to like and subscribe. When you buy shares, you become a co-owner of the company. Your ownership depends on how many shares are out there. If a company has 1,000 shares and you own 100, that means you own 10% of the business. Pretty straightforward, right? But things get messy when the company decides to issue more shares. Let's say a top executive is promised a bonus of 100 shares. The total number of shares becomes 1,100. Now your 100 shares no longer represent 10%. They only represent about 9.09%. That's what dilution is. Sounds small? Imagine you've invested serious money, and the company quietly hands out options, brings in new investors, or merges with another firm. Every time new shares are created out of thin air, your ownership gets watered down. The business stays the same, profits too, but your piece of the profit just got smaller, and it can get worse. Join our Telegram channel for updates on new videos and articles. You'll find the link in the description or pinned comment. Here's the kicker. Dilution doesn't just happen because of bonuses. It also happens when companies raise capital. Let's say a startup wants to grow, but doesn't have the funds. They issue more shares and sell them to an investor. Sounds reasonable. Now they have money to expand. But if that money is wasted, you, the existing shareholder, basically just paid for someone's reckless ambition. Now, dilution isn't always bad. Suppose the company raises $1 million and uses it to buy a highly profitable business. Sure, your slice got smaller, but the overall pie got bigger. And sometimes a smaller piece of a much bigger pie is actually better for you. That's what we call good dilution. The keyword here, efficiency. But there's another type. Imagine a company with a failing business model issues more shares just to make it through the next quarter. That money gets burned on executive salaries, rent, and ads. No reforms, no upgrades, and your ownership keeps shrinking. If you're not watching this, you're silently losing money. So how do you tell the good dilution from the bad? It all comes down to motives and results. If the company issues shares to buy something that makes real money, that could increase the business's value. But if it's just to avoid collapse, that's your cue to run. Ask yourself, did earnings per share go up after the new shares were issued? Did the company become more efficient? If the answer's no, you're probably being taken for a ride. Some companies try to offset dilution up front. For example, they buy back shares from the market or use founders' own shares to reward employees. That's fair. That's transparent. That shows respect for investors. But when shareholders find out about dilution after the fact, that's shady. Let's look at a real example. A company called Jolliver. At first, it had two shareholders, Joe and Oliver. Each put in $50,000 and got 50,000 shares. Equal ownership, 50-50. Then Zoe shows up. She invests $100,000 and gets 100,000 shares. Boom. Joe and Oliver now each own 25%. Zoe owns 50. What does that mean? She can now make major decisions on her own. And you, the old shareholder, no longer have control. Here's the twist. The company actually grew. They acquired a competitor, combined revenue streams, and increased profits. Joe and Oliver, even though their shares got diluted, started making more money. Their piece got smaller, but the pie itself got bigger and tastier. That's a textbook example of dilution working in your favor. But even that scenario needs careful watching. One wrong move, and Zoe, now in charge, could change the company's strategy. Replace the execs, kill off dividends, and you're left watching from the sidelines. There's also a reverse process: share buybacks. That's when a company takes its own shares off the market, which increases the value of the remaining shares. That's a good thing. It means the business is doing well and wants to reward its investors. But even here, watch the source of the money. If they're borrowing cash to buy back stock, that's financial gymnastics, not a genuine thank you. As an investor, you have to pay attention not just to profits, but to how many shares are out there. Profits may rise, but if the share count rises faster, your returns drop. Keep an eye on earnings per share using fully diluted shares. That's what tells you the real value of your stake in the future. Let's go deeper into the specific tools and tactics companies use to dilute shareholders, often disguised as growth and innovation. One of the big ones: compensation packages for top execs. Instead of paying big salaries, companies offer stock or options. On one hand, this supposedly motivates leadership to grow the business. On the other, it causes slow but steady dilution of existing shareholders. These bonuses can add up to millions of dollars worth of new stock that doesn't get counted in the valuation until it's actually issued. And just like that, your stake gets smaller, then smaller, and smaller, until you realize you don't own 10% anymore, you own 7%. But the real danger is when management starts using stock issuance to cover up failure. Let's say the business is losing money, margins are falling, debt is piling up. The execs tell you, don't worry, everything will turn around. We just need some time and capital. They issue more shares, raise money, and you, the shareholder, end up funding their promises. A year later, the company's either bankrupt or just stuck in neutral. That's toxic dilution. Your stake gets wiped out just to keep the lights on. We've just published a new article on our website. You'll find free content on stocks, bonds, and ETFs, whether you're a total beginner or already advanced. Go check it out and bookmark it. Another reason companies issue shares: mergers and acquisitions. When one company buys another, it can pay with stock instead of cash. This can be a great move if the company being bought is truly profitable and there's real synergy. But too often, these deals are just smoke and mirrors. The business gets bigger on the outside, but inside, it's the same old inefficient operation, only now more diluted. A good example? Cannabis companies between 2015 and 2018. Many of them tripled their share count just to expand, and their stock prices dropped. So now you own 1 million shares, but instead of owning 1%, you own just 0.23. And if profits didn't grow, your earnings didn't either. Here's the thing: issuing shares isn't free. It's actually one of the most expensive ways for a company to raise capital. Why? Because unlike a loan that earns interest, a shareholder is a partner and entitled to a slice of the profits forever. That's why good companies try debt first, cut costs, or seek partnerships. Issuing new shares is a last resort, so if you see a company regularly printing stock, that's a red flag, especially if revenue, margins, and profits aren't going up. Now, how can you spot dangerous dilution? First, track the number of shares outstanding. Most finance platforms show you that. Second, read the reports. Look for diluted EPS, earnings per share assuming full dilution. Compare that to regular EPS. The difference is your potential loss. Third, check for a buyback program. If the company is buying back shares, great. But ask yourself, where's that money coming from? If it's from free cash flow, awesome. If it's from new debt, that's risky business. Fourth, evaluate why they're issuing shares. Clear goals like investing in a profit-generating asset or boosting margins? That makes sense. But vague lines like general corporate purposes or improving liquidity? Red flag. That's like borrowing $100,000 from a friend just in case. And finally, compare. Look at how competitors operate. Maybe there's a company in the same industry growing without dilution. In that case, your choice is easy. But if the entire industry relies on stock issuance just to stay afloat, ask yourself if it's even worth investing at all. And remember, it's not just startups. Even big, mature companies dilute, sometimes to acquire know-how, sometimes to restructure, like issuing shares to gain access to patents or tech through a merger. That can pay off big, long-term. But as always, the devil's in the details. So investors should ask one key question. Will I be better off if my ownership shrinks, but the business grows? If the answer is yes, the company is now more efficient, profitable, and transparent, then it's probably good dilution. But if it's no, my stake's smaller and nothing else has improved, then it's time to run fast. Hit like and subscribe, and help support the content on our membership platform. Links in the description or pinned comment.